Well, welcome to the educational webcast sponsored by Corpco Retirement Group. Today's topic, cryptocurrency in review and the ongoing future. Every presentation is educational only that we do in this Corpco webcast. If you need specific advice on your own finances, please see your own CPA, attorney, CFP, financial advisor. So with that, always a good idea when we talk about a new topic. Maybe this isn't new because everyone sees it in the headlines, but it's certainly new in terms of defining better cryptocurrency or digital assets. You'll hear me use the two terms interchangeably. But what is crypto? I'll read kind of the technical definition that's out there. It's a class of digital assets created using cryptophonic techniques that enable people to buy and sell or trade them, meaning digital assets, securely. So obviously that's a very loaded sentence, and in your day-to-day exposure to it, if you're just reading headlines or maybe you've stuck your toe in the water, the first bullet, crypto is a form of payment. We're all familiar with Bitcoin, Ethereum's getting very popular, Tether, Cardano, all of that list on the far right make up different forms of digital assets. And in fact, as you can see with the third bullet, there's over 22,000 forms of these cryptos. We'll get into the discussion about initial coin offerings and how that works to basically open, some type of crypto market. But you can see, you can have a digital asset with as much as Bitcoin is supposedly trading today over 17,000 a share, down to pennies on the dollar for other forms like Cardano was like 30 cents a share. So you have to be very careful. There is a technology in crypto, which I believe is going to be the area where you invest for long-term in terms of investment. And that's called the blockchain. And why I feel strongly on the blockchain is not just related to this digital asset, but its ability, the blockchain, to act quickly as a form of exchange. We'll talk in a minute about how you transfer, say, US dollars to a form of digital asset, crypto, and make a transaction. But all behind the scenes is this technology called blockchain. And blockchain, another example, recently was talking to my doctor's office in the medical records area. And as you know, I'm certain from your own travels around health insurance and family using it yourself, it's pretty complicated, awful lot of players when you have a procedure done. And all of this blockchain technology could be very appropriate in better organizing medical records. It could be most helpful, as you've already seen, in the banking industry. The difficulty is it is decentralized, which allows it to act very quickly, but there is no middle person per se. No one's really keeping the records like a bank would in a transaction. The example we're probably all so familiar with this time of year is Amazon. You're going on, you're making a purchase, you're putting down your Apple Pay or your credit card, some form of payment, and it just happens, right? You don't think about it. But behind the scenes are a lot of steps going on to make the transaction occur. And that's what blockchain does in terms of the digital asset or crypto. So the last bullet, just to give you some perspective, approaching $1 trillion in value crypto across the markets. Fluctuating obviously a lot, but to give you some sense of markets, last Friday, the New York Stock Exchange closed at a certain level. The assets that were accounted for on the New York Stock Exchange were over 22 trillion. So even though crypto is in the news a lot, crypto is growing. It's nowhere near the market of a New York Stock Exchange. So as we kind of look forward more into understanding crypto, just a quick overhead on the positives to crypto and maybe the cons, pros and cons. It's accessible and liquid. I describe that transaction with blockchain. If you go on to do a transaction, transferring or transferring a US dollar to a form of a digital asset, it's pretty quick, very liquid transaction. It's readily accessible all over the world. And as I was mentioning, there is no real middle person, in this transaction. Transparency's certainly apparent. caused a lot of issues, obviously, with that recent bankruptcy in November of FTX, where no one really knew what the collateral was supporting any of the assets. Independent from central authority, I would argue that is where this FTX exchange, I believe, is going to open up a new door. And I think the new door will be a positive opening in terms of organizing a formal market where you can feel more comfortable trading digital assets. High return potential. Back in 2013, if you wanted to put it in terms of a share of Bitcoin was about $77. I mentioned to you recently it was trading around $17,400. That's a pretty good rise. If you were so lucky to get in 2013 and then get out in 2021, you probably could have gotten out around 62,000. But along the way, extremely volatile. The cons, volatility, I just mentioned, no government oversight. Transactions are final, meaning you make the transfer and exchange on the most common networks. Coinbase is very common. Once that's done, it's over. You cannot get back the transaction. Very different, right, than the credit card. You know, something went through, it was an incorrect purchase. You could fight with the credit card on your behalf to challenge the transaction. You can't do that with Bitcoin or any other digital asset you use. And limited use, meaning you don't have, obviously, your local stores all accepting any form of digital asset. You don't have the ability to utilize it on Amazon, to my knowledge, as an example. So, but stay tuned. So let's keep digging into it a little further in terms of, well, all right, Dave, well, how do you invest in this? I'd like to kind of sample it. I'd like to give it a try. So you pick an exchange. I mentioned Coinbase, which has been the most reliable. I'm never going to tell you it's secure and it's guaranteed, but it's been the most reliable exchange. So you put $2,000, step one, into your Coinbase account. What I would suggest is, if you look at number 3 item here, get a storage wallet, whether it's a digital wallet or whether it's what's called cold storage wallet. But the reason you want to do that is to give yourself a form of protection when you put that $2,000 on Coinbase exchange, so that you're more comfortable with one of these forms, whether it's Samsung Pay, PayPal, Apple Pay, that you can recognize the investment you made. Some of the trouble that FTX ran into, they ran into a lot of it, was they had their own crypto, which had ended up being no value to it at all, absolutely zero value. Secondly, a lot of people invested on that exchange without having a digital wallet, just trusting that the exchange would be secure. Obviously, it wasn't. So we selected a crypto exchange, Coinbase. We considered the storage a digital wallet. How much to invest? I mentioned $2,000 just to get, a sampling of this. If you wanted to buy Ethereum, it's about $1,300 a share. And manage your investments, meaning, keep an eye on it, get used to it. But again, the premise of any of this discussion is, if you can't afford to lose all of what you put into any digital asset or crypto, please don't bother doing it. It's not something you should do for any major part of your portfolio. No more than 5%, we're saying here in item 4, maybe even 2 or 3% at the most. But again, if you can't afford to lose it, absolutely do not invest in the volatile asset of crypto. So kind of as we keep moving forward in our discussion, I want to, get to this in the news, right, with FTX and this exchange. I just mentioned that you got to pick an exchange if you want to look at or get used to the digital asset, some form of crypto as an investment. Coinbase is very common, but there's a lot of others, Binance, Kraken. One that's getting more popular is Gemini. But again, what happened? In the middle of November, this group called FTX went bankrupt. For all intents purposes, in the Bahamas, they were illiquid. They could not meet any of the calls on the bank, which some of you may recall back in 2008 when the issue of Lehman Brothers, the investment bank, went out of business, Baird & Company. The difference is they had assets, in those investment banking concerns. There were no assets to be found yet in FTX. That's the concern, with lack of oversight on any of these exchanges and lack of organized exchange where you can comfortably say, like you would with the New York Exchange, it opens at 9 a.m. Eastern, closes at 9:30 Eastern, closes at 4 p.m. Eastern. You know, kind of from the trading, what the value of your shares are in investments. You don't have that yet with any of these crypto exchanges. But stay tuned. I think where you have a dark day like this FTX bankruptcy, you're going to have a bright sky, so to speak, with now more around the world agencies getting more serious about having control mechanisms in this business. So let's take a look at a process. And I'm going to turn it over to Anthony here in a minute. What is Bitcoin mining? This is a conversation that's ongoing, and I welcome you to ask questions away to understand better how a transaction works. Anthony does a nice job of explaining it. Just set up the discussion. Within the yellow hair is an Alice. She wants to buy a product. Let's say it's a bicycle from Bob. Let's say the transaction is $3,000, and she'd like to buy it from Bob using Bitcoin. So, Anthony, why don't you take the group through the process here?
Yep. So first, Alice will identify the product in which she's trying to make a purchase. And then with either her digital wallet or her cold storage wallet, we'll then proceed with the transaction. So since the transaction needs to have a proof of purchase, this is usually called a digital receipt. The transaction occupies one of those blocks within the blockchain. And you can see that in the image to the upper right. Next, a notification will be sent to what are called miners. And these miners will try to solve an algorithm. And then for solving that algorithm, they will actually receive a piece of the block in that blockchain or part ownership of it as a reward. Then this will basically tell all parties that the transaction is now complete, and then Bob will receive his Bitcoin or crypto, but in terms of this circumstance, it would be Bitcoin. And then usually this process takes, from maybe 1 to 2 minutes, and it's very comparable to buying products online when it comes to Amazon and you using your credit card. This is more of the behind the scenes of the crypto transaction.
So explain to the group a little more to it as far as the miner is concerned. I mean, how do they make money in this, and how are they involved in this?
So usually they'll receive a part ownership of that block within the blockchain, and all the block in the blockchain is just it's the proof of the transaction for the two parties, Alice and Bob, where the miner actually has you would call it shares in maybe more of the regular market, as we would call it. But in this market, it's like a piece of the ownership. So it will always say who the miner or owner is of that particular block.
Good. So more to understand about the transaction. If you're interested in buying a service or buying a product, I think it's more common with Bitcoin. This is that blockchain I was describing a couple slides ago, which is, as Anthony did a good job explaining the behind the scenes to the transaction. So as we look a little deeper into crypto in the news, talk a little bit about, this FTX and where I think it put a spotlight on the market, certainly in terms of digital assets and the need for a formalized exchange. The quick background on FTX was they had their own crypto called FTT, and that crypto, a digital asset, was supposed to be the collateral that was supporting their ability to give the liquidity event to an investor when they asked for their money back, similar to you want to sell so many shares of XYZ, call it Amazon stock you own, and you're going to put that order in and you expect to get cash back in your account. When investors put their orders in, so to speak, for a liquid event, and FTX went to what is their balance sheet, or was, and looked at security of how they could answer the calls of the investors wanting liquidity. They looked at the value of FTT, and basically it was worthless. So that started the internal event that over 24, 48 hours caused the, significant bankruptcy of FTX. So let's get a little more behind the scenes just so you have a basic understanding. And the reason to understand this better is as you get more involved in this digital asset business, as you try to understand it better, see how the future evolves. You can also see how quickly one of these entities, like a custodian, FTX, and exchange, can start and how quickly it could sink. Literally over a 4-year period, they went from boom to bust. One of the largest reasons, as I explained, is they did not have any collateral supporting their own crypto and therefore could not meet the demands of their investors. This again will create, I believe, a more serious, more expeditious dialogue on making this network more secure and having somebody that oversees these exchanges. So let's take a look globally. And this is a nice map that Anthony found, which really demonstrates the power of the digital asset, the power of blockchain, the ability to kind of get through barriers that normally would have, as we know, the bank in the middle or some other exchange, credit card company in the middle, some formal stock or bond exchange. This cuts through all those barriers and allows the transfer of a digital asset with no real centralization, no real what we would refer to as middle person. So I mentioned the term initial coin offerings a few minutes back. You know about initial public offerings you've heard of when a company goes public to raise capital that way. But initial coin offerings essentially is a similar concept where it's reaching out to investors and letting them become part of a particular exchange that ranges, you read, anywhere from $8,000 to $22,000 to get involved in an exchange. Not a lot of money, right, when you think of it. So that clearly is why you see over 22,000 forms of these digital assets. It just doesn't it doesn't necessitate a lot of capital to start an exchange. And that is one of its drawbacks when you look at the issues that are facing this technology. But interestingly, on this map, the only two countries that really have some form of ICO are Canada and Lithuania. All the other areas of the world, and they're certainly big ones, big markets, the European Union, China, Japan, all throughout Africa. Then you go into Brazil, Bolivia, Chile, undeveloped countries, but large markets, Mexico, and then the US. We don't even have a formal exchange. But stay tuned. Again, it's too bad that it takes sort of the disaster of one entity or a group of entities to build more formal approach to a technology and an investment. But that is, I think, what will occur. But just I'll leave you with a thought again on this map. It just shows you, I think, more of the strength of the digital asset market, the strength of the blockchain, the ability to kind of coordinate transactions around the globe very rapidly, an interface. So let's bring this into, what does the future look like? Bitcoin, again, this was, more towards the end of November. Anthony was doing a lot of research. As of last week, it was trading a share of Bitcoin, 17,470. Still a far cry from where it was in the middle of 2021, over 60,000. Very volatile, goes without saying. A lot of exchanges, I think, will go, unfortunately, the way of FTX, maybe not as colossal a breakdown, but you're going to have a similar crisis as things kind of weed out what I refer to as the low-hanging players that are in this exchange business. Bit mining has become more difficult, right? Because you're trying to make money as a miner, as Anthony described, solve an algorithm, solve a puzzle. It's getting more restricted. The ability for the miner to find a buyer and a seller, basically, in the digital asset transaction. So with that, let's take a look at the quick chart. And this is just a good demonstration, I think, to again, drill home the point of the volatility. It's great that maybe you were one of these people, or somebody, or someone in the family's bragging at the family event. Oh, I was in early. I got in so early, and I rode it way up and got out at 67,000. And my initial investment was less than $100. There's people that probably did, but likely they got back in, and the volatility that happened towards the middle of 2021, as you can see, was significant. So now we're hovering around this $15,000 to $17,000 price range. I do not know if that is just the start of another bottom, a start of a growth area. I would suggest the volatility is really the example in this graph. I have no knowledge of where the price will head, other than, again, to demonstrate, just be careful and understand, what you are getting involved in. So let's take a quick summary. 4 things to know about crypto. I keep harping on the volatility, but I can't say it enough. Really and truly, don't get involved in this unless you can afford to lose everything you put in. It's that type of trade. Having said that, though, we talked about the Bitcoin. I feel the Bitcoin has led the way in discussion. There's a lot of other exchanges that are embracing Ethereum, embracing what's called Calvaria. I believe I'm saying it right. So there's other forms of digital asset, but Bitcoin certainly and Ethereum have been in the news the most. The blockchain, keep that in mind. That's really, I believe, the long-term investment frontier that's being born out of this discussion in this industry. But be cautious again. We don't even know who the founder of Bitcoin is, right? We know that Jeff Bezos founded Amazon. We know Bill Gates was one of the founders of Microsoft. But who is the founder of Bitcoin? I know we could dig and probably come up with a couple names that they credit with that. But that's another example. I mean, where did this start? How did it start? Fraud's easier now than ever, but I think stay tuned. I mean, the FTC is certainly getting very nervous, very conscious about these markets and the scams that could develop, what you hear referred to as pump and dump schemes. And the track record, even though you saw that graph that Bitcoin has been around, at least the period of time, 8 or 9 years, but nonetheless, if you have 22,000 forms of digital assets, is there really a track record you can rely on across the board for an average? Not yet, but, stay tuned. I want to wish every listener a real happy holiday and have a very healthy new year. Make 2023 a good one. We'll talk to you soon.